What on earth is going on? How long will this go on for? Surely the spectre of regulatory clampdowns has perhaps all been priced in.
Well, Rishaad, I mean, it is a very trying time, and there is a pretty poisonous cocktail of challenges that China is facing right now between geopolitical risk, the ADR concern, and now the most recent flare-up of COVID that is taking place. So there's no doubt that the near-term issues are very challenging. We think our numbers have accounted for a great deal of this. Our GDP growth forecast for this year is just 4.5%, whereas the official target is 5.5%. Our EPS numbers, which we've changed for the region as a consequence of all the broader global shocks, particularly the oil supply side shock that's emanating through the world. We've taken our numbers for the region down, but actually kept them unchanged in China because we already were at just 4% EPS growth for this year compared to 14% for consensus. Now, if you look at what's priced, we would note that particularly with the sell-off in the ADRs on Thursday and Friday in the U.S., that the offshore ADRs are trading at a 3 standard deviation below what their normal trading range is. They're trading at 70 times earnings. They're trading at a 10 PE point discount to the U.S. tech shares. So we think a great deal has been priced in. The challenge really is what is the catalyst that's going to change that? It's harder to identify that. So really, I think wrapping all that together, that the prognosis is it still is going to be a bumpy ride in the near term. But strategically and fundamentally, there is clearly upside potential here. And that's why we remain overweight on China and think that there could be decent and actually quite attractive returns on a 12-month view, even if the next several months are going to be potentially challenging.
Yeah, for the long haul, certainly tech may well be a play here, given that some of these companies are rather, well, they're quality companies. But nearer term, are we looking at a spending boost here and looking at some of those infrastructure plays?
Absolutely. If you get down to the brass tacks, so to speak, in terms of where we think one should be positioning, how you apportion your portfolio in the nearer term, one area we think that you really want to focus on is where there will be policy support, what we call the so-called policy put. And here we have identified previously a list of so-called new infrastructure companies that will benefit from infrastructure spending, but particularly in the parts of the economy that are being more supported by policy. And that would be in areas of the so-called new economy or more, or the green economy, which China is particularly focused on supporting. More broadly, we think that the theme of common prosperity is one that will continue to receive policy support. So those would be the two areas that we think investors in particular should be focusing on at this point.
Tim, overweight China, what would you be buying right now? HS Stack massively oversold, but you know what? It is for the brave.
Haslinda, there's no doubt it's for the brave. And I think that where the challenge is it's harder to point to an immediate catalyst right now that will staunch the selling that is going on. That being said, I think we should remind ourselves that markets always do tend to trough before the coast is completely clear. I mean, if you recall 2 years ago during the first sell down when the COVID pandemic first arose, we saw markets trough late March, early April, well before there was any sign of either a cessation in the growth in caseload or even the appearance of any sort of a vaccine. And we've also seen similarly markets trough before the fundamental picture actually clears. Now, that's no guarantee that things will turn around immediately, but it does suggest that when the risk reward is such that fundamentals are clearly on your side, just to give just one statistic, the MSCI China index is trading below 10 times earnings right now. Even though we think fair value has come down, we still think it's more 12 times earnings or greater, and that plus some earnings growth can give you 20% upside over the next 12 months. So we do think from a fundamental perspective that there's clear attraction here, and I think the challenge is really going to be looking for what the catalyst is that will turn things around.
So, Tim, what would make you turn bearish on Chinese stocks? I mean, already at 5.5% GDP growth, people are saying it is overly optimistic. We have all sorts of pressures. What would make you rethink your position on Chinese stocks?
I really think that if we don't see any clear sign of policy support, then that would open the door towards greater fundamental weakness from the various challenges we've already been discussing. And that could lead to some further de-risking and also reduction of fundamental estimates. So I think we really do need the policy setting to ease in a more clear and apparent manner, and that to be reflected in the nearer term activity measures. I think if we don't see that over the next month or two, then I think numbers will have to come down further, and that could open the door to some further downside.
Tim, going the other direction is going to be the Federal Reserve Wednesday, looking at a rate hike here. Now, the question of the day that we have is how will a Fed rate hike affect assets? I suppose some of this will be contingent on 25 or 50 basis points. What are your thoughts?
So our expectation is very clearly that they will go 25. We'd be quite surprised if they did 50, given the global backdrop. We are expecting that the Fed will raise 7 times this year because they are clearly behind the curve in terms of where inflation measures are. The market, interestingly, has gone from pricing 7 down to 5, and now, as this morning, is pricing nearly 7 hikes this year. So I think the market's been oscillating a little bit in terms of how much the Fed will do. I think the challenge overall is not that this particular hike is going to be a surprise. It's probably the best telegraphed Fed hike, on record. But it's more that the Fed is clearly hiking into a period of fundamental or weakening fundamentals. And that, I think, raises the specter of a stagflationary environment looking forward. That the word stagflation is cropping up in client conversations to a much greater extent. We've done a great deal of work on that. My colleague on the global strategy side just wrote a paper on that last week. I think that's the challenge for markets right now, is the extent to which the combination of slowing growth and firming policy and tightening financial conditions, which typically is not a favorable environment for equities. The challenge is how much of that has already been priced.
Tim, 5-year yield at 2% for the first time since May 2019. 10-year yield at the same level. At what yield level will equities be hammered?
So I just divide the answer to my question into twofold, Haslinda. So what you imply by that is that the yield curve is basically flattened and may go negative, and typically that's a precursor signal to a recession. So I think one of the concerns the market has is whether or not there will be a recession. We've just noted in a paper last week that there is now the market's now pricing about a 20 to 30% probability of recession in the U.S., and that would be roughly consistent with where our U.S. economists feel the chances for that are. Now, clearly, if you've got a fundamental recession, then that's a less favorable environment for equities. And I think that's what the market is beginning to try to price. We just, in a paper we released this morning, noted that whenever there are 10% corrections in the global equity market, that the ensuing 6 to 12-month performance really deviates according to whether you have or do not have a recession. Even if you do have a recession, you can still get positive returns, but they are certainly more delayed and less strong than if you have a correction without that fundamental economic downturn. So I think that's really where the market is at right now. To your question about what level of rates will prove challenging for equities, we have already baked into our estimates a 10-year U.S. Treasury yield of 2.3% at the end of this year and going higher somewhat into 2023. So we are expecting that. I think that markets are priced for that. If you had much more of an overshoot beyond that, say getting to 3% or even getting closer to 4%, that would clearly, from a valuation standpoint, be much more challenging. But at current levels or even somewhat higher, we think that the market's already priced for that sort of yield.